Yes. Good evening, good morning, good afternoon, wherever you are. Today we decided to do this session on TikTok live for everyone. Yeah, we are going to look at market structure. So today we are looking at the secrets of market structure that they never teach you. And we all know that market structure is a key point or something that we need to take serious when we are trading. Everything concerning trading, if you want to trade like a professional, you have to master what we call market structure, because market structure will always give you the direction of the market, where the market is going to go. The market changes. Today is upside, tomorrow is downside. It keeps on changing. But how do you manage to see that now the market is going in this direction? How do you happen to know that now the market is going to change the direction? So these are the things that we wanted to look at today. And maybe by the time we end this session, most of you will have got something different, or you'll have a new way or a new approach to the market. Hope my sound is very clear, and my screen is also clear on the screen as I projected it. Yeah, you can click on the like button, share for other people who are not here, maybe, so that they can also benefit out of this session that we are having right here. Otherwise, our community, our Telegram community channel, the link is in the description or in the bio. You can click on the link and join the Telegram channel, where we share some of the setups or signals that we get. Today we've been trading gold, and we shared some setups, upside and the downside as well. As you can see, we are already in a trade that is running. The setup was shared earlier, and the signal was shared as well, and we are already running in profits. Though even during the day, there is a setup that we shared also. It made profits before we see that the market changed the structure. So the market was in the bullish during the day. We anticipated the market to continue bullish, but it changed to bearish. So today we want to know, how does it change? Before the market dropped, everybody was expecting a buy. Those who mastered market structure could see that the market is now in a sell. And with proper risk management, of course, even if you were in a buy, you could have not lost a lot of money. Otherwise, let's jump into something very serious. So we have 8 modules of market structure, and I want to explain these modules. Depends on the time that we shall have, but I will try to explain all these modules and for everybody to understand. The first one, the foundation of market structure. The most objective is to understand how price truly moves. I will try to put this down and have this blank space or blank page to illustrate the proper market structure, how it moves. For the case of market structure, the structure is not about lines. It's about knowing the trends. briefly, we have what we call uptrend. Try to put this. We have uptrend, then we have downtrend, and we have sideways. Here, the market forms highs and lows when we look at the trend. Then we have what we call impulse and correction. We have what we call internal structure internal and external structure. In the Telegram channel, I'll try to share images explaining this, but I'll try to explain them step by step. So these are the foundation of market structure. If you don't understand this, you will not understand what market structure is, and it will be very hard for you to be profitable in a long run when you are trading. I want us to understand this clearly today. Usually the price breaks the structure at significant support and resistance areas. Let's say in an uptrend, you will find the market giving us series of higher highs and higher lows. Series of higher highs and higher lows. We'll mark these points as higher highs. So whenever you see higher highs, that means that's the highest point, and we have higher lows. That's the lowest point in a bullish structure. So as I said, the price breaks the structure at significant support and resistance. So the market will start from a lowest point and give us a high. When it gives us a high, this will be our swing point, which is a higher high. Then the market, you will see the market coming down, giving us another point, which is a swing low, which would mark as the higher low. At this point, if the market comes and crosses above this previous higher high, we have what we call a break of structure. We have what we call a break of structure, meaning the market has violated the previous high. So it's no longer our previous high. The market is giving us a new high. So if it gives us a new high, we have this as a new low. What happens is that this will become our new swing point. This will become our new swing point, which is the higher high. The reason as to why this is considered a higher high is because it's higher than the previous high that we have. Because we have a high here, but if we have a new high here, then this becomes a higher high. it's a high point that is higher than the previous high that we have right here. Same applies to the lows. We have a higher low, but if a new low is formed, then this becomes our higher low. So we said the market breaks structure at significant support and resistance levels. If you happen to look closely here, you can see that we have this point here. What we have here, before the market crossed above this higher high, this was our resistance. But when the market crossed and gave us a new high, having this as a new low, because always the market has to come back and retest the previous high, this becomes our support. So if we are happening to take positions or we happen to execute trades, we execute buys at significant support levels. That's why we always say we buy low when the market is in bullish. So the low that we are always talking about is the support. This support is always in the zone where there is the previous high. That's why you see that the market will be going like this most of the time, always. So the vice versa of this is the bearish. So this is a bullish market. And in the bullish market, we always look for buys. What happens is this, like for example, right here, somebody may jump into the market at this level and this person is anticipating a buy. Yes, the market is in a buy, but this is not the right place to buy. What you're supposed to do is to be patient and wait for the market to come back to the significant support level or to come back to retest our previous high. That's when you execute. So as a elite trader or professional trader or a trader that knows how the game goes, what you do is you wait for the market to come back to this level where you see our previous high, because the market will always come back to retest this previous high. As soon as the market gives you signs of reversal, that's when you execute. Then you execute having your stop loss below this zone, which is the support zone. So this will become our previous high, and this will become our current high point, which is a higher high, a high that is higher than the previous high, and this will become our new higher low because it's a low that is higher than the previous low. Then once you execute, you will have your stop loss below here. Then you can have this high point as your next take profit or your target. That's how we trade, following just market structure. As I said, the price breaks the structure at significant support or resistance areas. So for the case of the resistance areas, the market will break above the resistance if it's in bullish, and it will break below the support when it's in bearish. I hope that has been understood. That's for the case of uptrend. So as we are done with the uptrend, I will briefly explain the downtrend as well. It's just the vice versa of this. So in the downtrend, you will find the market giving us lows, highs, lows, highs. So I will just use the same support and resistance that we have here. So what's the difference here? Here we have lower highs and lower lows. Lower highs and lower lows. When the market is in a bearish, we'll always have lows, or the market starts with lower points. It can either be a lower low or a lower high. So if it's a lower high, that means it's a high that is lower than the previous high. Just something very simple. The difference between the two is this starts with high points. The bullish starts with high points and bearish starts with low points. So this is a lower high, this is a lower low, lower low, lower high, lower low, lower high. When the market is in a bearish, the market will always break the support and retest. Will always break the support and retest. Once the market breaks the support, it becomes our new resistance. And if it's our new resistance, we always look for sales at the resistance. That's why we always say, if we are selling, we sell high. So which high do we sell at when the market is giving us a new lower high? That's where we execute sales. We don't execute sales at any point that you can see that, oh, since you see the market is in a bearish, then you just enter because you see that it's in a sell, then you just enter a sell. You may enter a sell, then that's just a mere pullback, kicks you out of the market. But if you happen to be patient and execute at precise key levels, then that's where that's where you can master the craft in trading, and that's where you can be profitable in a long run. So as you can say, as you can see here, just to emphasize or to make it much easier for you to understand is, in a bullish trend, the price breaks its previous, in a bearish trend, the market breaks its previous lower lows, whereas in a bullish, the market breaks its previous higher highs. So this is when the market is moving in the bullish trend, or when the market is moving in a specific direction. So now I want us to look at when the market changes. When the market changes from, let's say, from an uptrend to a downtrend. As you can see here, the market is in a bullish. So if the market happens to come to this level, then does not violate this high, or it doesn't pass through or break above the high, and it decides to change the direction just from here, giving us two equal highs. We call these two equal highs. I'll use this, two equal highs. If the market gives us two equal highs, in chart patterns, we call this a double top. Then when do we confirm that now the market has decided to change the direction? If the market breaks below the previous higher low. If the market breaks below the previous higher low, then we have what we call a change of character. I'm sure most of you have been know what a change of character is. A change of character is the first signal that indicates that the market is likely to change its structure. If it has been in bullish, it's now likely to change to bearish. That's what we call a change of character. But a change of character is just a first signal. It doesn't confirm, because sometimes the market will make a change of character and it still continues to the upside. Continues to the upside and violates this. Then that means the market has just given you what we call an inner structure, not the external structure. When do we confirm that now the market has seriously broken? It has seriously changed the character. If the market goes back to our previous, this point here, higher low, and retests it to give us a new lower high, then it pushes to the downside. So when the market goes back to retest and it changes. It gives us what we call a lower high. The difference between the two is a lower high is on the bearish structure. So which means the market that was in a bullish structure has now changed from bullish to bearish. From bullish to bearish. Now the market is no longer giving us higher highs and higher lows. It's giving us lower highs and lower lows. Hope this is much easier to understand. This is a lower low. Why is it a lower low? Because it's a low lower than the previous low. This previous low that we saw that the market broke or violated to give us a change of character, it was a higher low. But now we have a new low, which is a lower low, because it's the lowest point, or it's a low that is lower than the previous low. Then we have a lower high here, which is a point that is lower than the previous high. Since we have a higher high here, when we have a new high that is lower than the previous high, we call this a lower high. Then what do we do is, after confirming, because this is now a break of structure that we have. A break of structure simply is just a continuation of the previous structure. A break of structure indicates that the market is still continuing in the previous, in the same trend, just as you can see. So always, what do we do? Since we have seen a break of structure, we be patient to execute the market at this point where the market has given us an indication of a new okay, what's wrong with my chart? Sorry guys, let me put the chart back here. Yeah, hope it's clear now. So as I was explaining, what we do, we be patient, we wait, because we don't just execute. Elite traders or professional traders, they don't just execute anyhow, even if they have seen that the market is going in a certain direction. What they do is they wait to execute at precise entry levels. Which precise entry levels? If it's a sell, we'll wait to confirm a new lower high, then that's when we'll enter. So what we do is we mark this as our point of interest. So our point of interest is here, because we expect the market to give us a new lower high at this point. That's when, because it has to come back to retest this lower low. So when the market goes back to this point and we indicate that now it's coming to the downside, that's where we execute to take our sales and have this as our take profit. I want you to understand this. Understanding this is very easy, but putting it into action is the hardest thing. You need to have discipline and you need to be patient. Without that, it will be very hard for you to master this. It will take you some time for you to master. So you need to push yourself into having proper discipline for you to understand this very clearly. So these that we are having, we have, I've explained the trends. That's the uptrend and the downtrend. So the next trend that I will explain is the sideways, when the market is in a ranging market. When the market is in a ranging market, it's always giving us what we call equal highs and equal lows, or the market is in sideways. Sometimes they say it's consolidating, ranging, or it's moving sideways. Here the market is giving us equal highs and equal lows. You find that we have equal highs at the same levels, highs at the same levels, and lows at the same levels. For professional traders, you will have to wait to see which direction is the market going to give you. If the market may either break above or break low, on the lower side. If it breaks on the lower side, then it means that the market has given us a direction that is continuing to is going in the bearish direction. So meaning this would be our change of character. So what we do is we wait for the market to come retest this previous low here, then continues to the downside. But if it's on the upside, then the market will give us a direction. Once we confirm it, then we wait for the market to come and retest this previous high, then continues to the upside. I hope that is understood. For any query, guys, my number is on the profile, or you join our Telegram channel, then you send a question, or if you happen not to have understood, or you enroll for mentorship for you to be able to learn. Currently, we are not having any physical classes. At the moment, our offices are closed for classes, physical classes. We only have online classes, but updates will be shared. Hope that has been understood. So something else that I wanted to explain more, maybe, or that is impulse versus correction. Well, when the market is moving, we have what we call impulse and correction phase. Impulse, correction. If I happen to look closely to the market, you will always find market whereby the market has so many candles packed together in one zone, and you'll find sometimes bigger candles going to a certain direction. If the candles are going to a certain direction, that phase is called an impulse phase. The market is in an impulse phase. But if you find that the market are packed in one place, that's what we call a correction phase. So when the market is breaking out of a certain trend, we have what we call a correction breakout and an impulse breakout. If you happen to see an impulse breakout, just know that the market is now going to make a correction, then it will continue to the reversed, the previous direction. But if the market happens to break in a correction phase, like for example, the market decides to break in a correction phase, then that implies that the market is still continuing to the previous direction, the same trend as the previous trend. This is just for those who are advanced to understand. What we do, we only adjust to have a proper picture or proper structure for the market. Well, I've been using lines to draw this, but in actual sense, the market is shown as candles, not this. So let's go back. Let's go to this. Let me try to use this. Go to a smaller time frame maybe and indicate this clearly for everyone to be able to see this. So gold, before we all expected to see gold buying, if I'm not mistaken. Gold was giving us series of higher highs and lower lows, higher highs and higher lows, as you can see. Then we see that the market happened to change the character, then break of structure, then the market continued to the bearish. If you can all see that, it's easier for you to understand. I may not draw it accurately, but at least you can get the exact picture on what I'm trying to explain. Yeah. So always what happens is that the market comes back to retest these previous points, as I had explained earlier. If you can see very well clearly, the market always comes back. Not until the market happens to break the structure. As you can see, it breaks the structure, then it continues to the upside. continues to the upside. Even at the upside, when the market is in upside, you can see it gave us new higher highs until it broke out to give us lows. That's why we are selling right now. So that's how we move, guys. We move once we anticipate that now the market has changed the direction, then we change. We have to evolve with the market. Don't get married to one trend, because the market has been trending. You keep on buying without looking at the structure. If you master the structure, you will know that the market now has changed. Now it's going bearish. It has been bullish. Now it's going bearish. Just because of time, I may not explain furthermore modules. I've at least explained one module. But if you really want to get to know much, then I would just advise you to join our Telegram channel. The link is in the description. Enroll for mentorship for you to learn other modules. Then you will happen to master the market. Good. So as you can see, right now I will share this setup that we have. This is what we have currently. This is what we have been following. Yeah, this is what we have been following, and we had entries from this level and our stop loss just here. So we are expecting, we have this as our final take profit. However, we have also smaller levels where we expect to take small profits or secure profits whenever the market happens to reach those levels. So if you are looking onto gold, this is what we are seeing at the moment. So we expect the market to push up to that level, even furthermore, because I always explain this in the VIP. I won't share it here, but those who are in the VIP, they know when we happen to find patterns like this, we know how much we measure the next possible pips that the market is likely to cover, not until maybe the market gives us a change of character. However, when I happen to look at let me try to go to a smaller time frame, which is a 1 minute. Guys, I don't advise people to trade 1 minute unless if you really know what exactly you are doing. I always use these 1 minute just to have precise entries so that I don't happen to have bigger stop losses, or when I'm to scale in, especially if I'm having positions running and I want to put in more positions, I'll go to smaller time frames and look for more positions, and so that I can maximize my profits in one single setup. Otherwise, it was a free session, guys. I hope you all enjoyed. I hope you learned something out of this session. Yeah. You can, what you do is, if you want to follow more of this or get to know much of this, you join the community for you to be able to understand this. We have several modules of market structure that can help you. We have the strong and the strong highs and weak highs, strong and weak highs and lows. Yeah, the strong lows that protects market structure, and weak highs that are likely to be liquidity targets. We have a break of structure versus the market structure shift. Yeah, if you have happened to have seen what a BOS and a MSS, we have multi-time frame structure, we have premium and discount. That's when we are dealing in ranges. We have liquidity and structure engineering. We have a specific structure behavior for gold. Those who want to master gold, we have a specific structure behavior for gold. That's for scalpers and swing traders as well. Yeah. Thank you guys for attending today's live session. I hope to meet you next time if we are having another live. What you can do, follow the page and click on the notification so that if we are on live, you can easily get to see that we are live. Then you happen not to miss anything that we share. Otherwise, I would like to wish you a good night.